What defines success?
The practical reality is that I like the capital markets, I like competition, I like pressure, and I like intensity, and I would pay to work for someone if I could do all of those things on a global basis.
What happens when you get knocked down?
My analogy is Ted Williams, who bat 400, he was the best hitter in time, but he made out 3 out of 5 times. So we know we're going to make mistakes. So you have to be practical about life.
What makes some people radiate?
I'm not working, and I haven't worked since I started. I actually have a passion for the markets.
This is Radiate.
Hi, everyone, and welcome to Radiate, the show where we interview some of the world's most successful people to find out how they work their way to the top. This week, we have Mario Gabelli. He's a legendary value investor. He's like Warren Buffett, digs into financial reports and buys underpriced companies. He's the founder of GAMCO, an investment firm with just under $40 billion in assets under management. When he talks, Wall Street listens. Now, we've had quite a few entrepreneurs on our show lately, but what if you're not interested in starting your own company? What if you're one of the thousands of college grads or MBAs who are about to join a Wall Street firm? What is it like to work for a guy who's worked his way up all the way from the Bronx, MG from the block, to the top of the finance world? What lessons can you learn from him? So here we go with Mario Gabelli. All right, Mario, so I don't think I've ever actually talked to you about your childhood. Seriously, and sort of what drove you to become such a big success. So tell me about growing up in the Bronx and how that shaped who you've become.
That's a few years ago, like 10 years ago, our forefathers created this world.
Oh, come on, Mario.
Essentially, it was a totally different world. We lived, and I was born in a block off Park Avenue, where the train station goes down to New York City. And between that, you go Park Avenue, Washington, Batgate, and 3rd Avenue. And there was an L called the 3rd Avenue L that went from the Bronx, Gun Hill Road, all the way down to Chinatown. Mm-hmm. And when you're 4 or 5 years old, you can get on the train because nobody bothered you.
When you were 4 or 5?
Yes, you can't deal in the culture of today. Wow. In addition to that, you can walk down the street because it was extraordinarily safe. You walked out and we were dealing with an area in the Bronx between Batgate Avenue and 174th Street and Claremont Parkway that was the same as Orchard Street in Manhattan. Lots of little shopkeepers, and you would watch them buy stuff, and you'd watch how they negotiated price and so on. It's a very entrepreneurial setting. And so because you're young, you can go do that in that environment. And that was a sense of independence that you can't do today because your parents would be put in jail for child abandonment.
Right. You'd be, right, exactly. It'd be child abuse, I guess you could.
I don't know.
I mean, you weren't abused as a child, but people would say, oh my goodness, like how could you do that to your kid today?
I actually disagree with you. Nobody even thought about that.
Right.
It was not even in the mindset. Only the world of the last 50 years has changed that mindset, or 70 years.
But do you think it was the environment that created your entrepreneurial spirit, or did you already have that in you?
Oh, I can't answer that. I think it was the environment.
You do?
I don't think it was genetics, DNA, though my parents having left for Italy to come to the United States, that clearly they were adventuresome and they were frontier seekers, but I don't know the answer to that. So let's call it a blending of the both.
Did you always know that you wanted to start your own firm eventually?
I actually started my own firm when I was 5.
How?
At the 3rd Avenue L and 174th Street, I had a shoe sign box, and I would basically put the price down of the shoe signs and go out and start.
And shine shoes.
And shine shoes. Make 10 or 15 cents or whatever the going rate was.
So that was your first business?
Yes, it was actually.
Okay. So when you left though and started Gabelli, right? I guess what was the original name of the firm?
Well, let's do back, okay? I went to local schools. I was, for example, the Catholic school system would have bingo on a certain night of the week.
Right.
There would be 1,000 people that would show up at this particular location in the Bronx, And I would go there, and they didn't offer cigarettes. So I would go buy cigarettes by the carton and sell them by the pack. I would do things like become a caddy, which was entrepreneurial and where you did your own time and set your own time. I would have jobs during high school where I would do things that others wouldn't do. Then I had, during college, I would organize individuals that would take students to Puerto Rico or Bermuda, and I would be the chaperone, but we would we would buy and block tours on a group rate. And then when we were in college, we created something called JMD Enterprises, where we would run dances and hire the band, the bouncers, and the booze.
What was it called?
MD, John, Mariel, and Donald. And John is very successful today as an academic, and Donald is a very successful lawyer today.
And you still are you still in contact with them?
Barely, but often, once every 50 years on a reunion.
That's interesting. So from those ventures, I mean, how much did you make, and what did you do with the money?
Well, I bought stocks. I mean, I started investing in the stock market when I was 12 or 13 years old, and partly due to the fact that when I caddied, the other caddies would leave because they were bussed up from Yonkers into Scarsdale, and then I would stay around because I would find a way back by hitchhiking or taking a bus or somehow doing that. And
wow.
So the specialist would come up after the market closed, and I would be there and would either go around and play 9 holes for them and listen to about what they were doing in the stock market. So I got captured at around the age of 12 or 13.
You see, I didn't realize that. So so a lot of this learning in the stock market, becoming an investor, you did all of that on the street. You did a lot of that on the street.
Well, you didn't learn about how to become an investor. You learned about the stock market. You learned about the stocks. You learned how to buy and sell, and you kept close tab by reading the Journal, the Business Week at the time, and you would do all of that. So I used to read Business Week every week, starting a few years ago, and the Wall Street Journal. And then in addition to that, which you wouldn't know about, you would get prices by buying a newspaper at 5:30 or 6:30 called the Journal American. It would come out after the market closed, and you would get closing prices that way.
Right.
And they'd be somewhere between 6:30, 7:30 at night or something like that.
So Mariel, tell me, because you talked about this before with me, but I want you to retell the stories about how, like, the moment where it was an inflection point in your career and you said, you know what, I'm going to go out, I'm going to start my own firm.
Well, it was always the case of not working for someone during school. Ideally, you did have a couple of jobs in the office, but I joined Loeb Rhodes on a Monday, having graduated on a Friday. Michael Steinhardt quit on a Friday and started a very successful hedge fund called Steinhardt, Berkowitz & Fine, one of the most successful 20 years until he retired in the early 90s. So I picked up all his industries, but having known Michael and what he was doing, I understood the world of hedge funds. So it was pretty evident that at some point in time you would start your own firm. Mm-hmm. You would take the risk and do it. What happened then is that I left Loeb Rhodes and went to William D. Witter, knowing full well that May of '75 was coming. May of '75 was the day in which commissions would change for the first time. And the business model of firms like William D. Witter, which had pure research, but had salesmen, traders, and analysts, that model would change. So basically, William D. Witter merged into Drexel, was taken over by Drexel Burnham, and I stayed there for 3 months and basically started an institutional research firm on January 1st, 1977.
I love how you remember the date exactly.
Well, it was pretty simple. We went public in 1999, and we split the company up finally after 19 years of being public or whatever it is, and 40 years of being in the business.
On this podcast, right, or on this episode, we like to talk about people's ups and downs in their career. So tell me, what was a really big low in your career, and how'd you learn from it?
Well, you knew, having been involved in a variety of businesses, for example, going down and to pick up boxes, reusable boxes in the basements of supermarkets where there was a lot of interesting food stored and a lot of locals like rats walking around. You always expected the unexpected. And so you prepared for that. And there was a lot of things you did when you were growing up in the streets of New York that prepared you for the unexpected. And as a result of that, when I started the firm, there was a telephone strike. So we couldn't get a telephone. Remember, this is a world in which no cell phones. So you had to have a payphone. There was no payphones in this building of 40 Wall. You had to go to the street. So you had to stand on the corner of Wall and William in a payphone in the snow, because it was January that I started. And one guy, Mickey Jaffe, comes walking by and says, "Oh, Gabelli, that's what you meant when you said you'd have an office at the corner of Wall and William." So the reality is, you couldn't get a typewriter. It took 3 weeks. You couldn't, the first research report we wrote was probably had a mailing list of 200 individuals that I had called on. And I was wondering why nobody would call me. We licked the stamp on the envelopes and put them in the envelope and send them out. Post office calls and said, "Mr. Gabelli, we've got about a X number of envelopes. You didn't put stamps on." I said, "Oh no, I did put the stamps on. I licked them. I put that." He said, "You put XYC, like 13 cents, but because it was a big envelope, you needed to put 25 cents. I said, "Okay, why don't you put them on and send me the bill?" He says, "You have to come over here and lick them on yourself." And it was snowing. And it was a blizzard, and you had to walk from Wall Street down to the post office, which was on the other side of Broadway. So I walk into where the guy told me to go. I said, "I'm here, here's the money." He said, no, you gotta go back up the block and buy stamps and come back down. And then you have to lick them on yourself. So there's always surprises, whatever business you're in.
Or you thinking to yourself, what am I doing?
Well, it's learning curve. In other words, every business, so that when you are an analyst and you hear about companies that are starting facilities and you say there's a learning curve or a ramp rate or something like that, you say you fully relate to that and you understand it, whether that was not very technical, that issue, but it was very hands-on. And so if you want to be entrepreneurial, you got to expect that the old garage, but this happened to be 40 Wall. And
so how do you feel then, Mario, about building a business today and how it is so much easier? You don't have to walk.
No, that's not true, because it's more complicated because of the increased number of regulations versus what they were in the mid-'70s. Okay, there were large barriers to entry, and the notion of data and the gathering of data, which we do, well, it's quicker and more instant. It also creates greater pressure to be more current on a quicker time frame. In addition to that, the notion of being public was not something that we did in the mid-'70s. And because of what happened with Enron and companies like that, WorldCom, you basically had rules like Sarbanes-Oxley that's cost us millions of dollars that have been totally unnecessary, because they had to comply with some rules. So they make rules that one size fits all. Doesn't make sense. It chokes off the entrepreneurial part of the American spirit. It chokes off risk-taking, and that is a challenge.
But that's only for but you're only talking about one corner of the entrepreneurial world, which is financial firms, though, that have to deal with this regulation.
But it's the same. If I was a bodega in Manhattan, the notion of how do I take food stamps in, and what do I have to do for that, and how do I do for accounting, and what do I do for taxes? So everything on a relative scale, I disagree with you completely. I think regulation is a chokehold on entrepreneurialism. It is a burden that is totally unnecessary. And you've got to allow the free market system to foster, and that is a chill factor. Notwithstanding that, going back, so what happened with us is that we were in a business where you knew your expenses every day, but you didn't know your revenues. That's the nature of a transaction business. So that was always a challenge. That was also a lot of pressure, because I had 3.5 children. They had to eat. Did
you ever think you'd run out of money?
That was a possibility, but not one that I was concerned about. The problem is, when making from let's say $100,000 to $5,000 in a year, you have to worry about what happens in your second year. I always knew I can get employed somewhere else, because I had the confidence from being able to pick stocks for an extended period of time. I had a very good Rolodex of people that bought my research over the preceding 10 years and knew that we could make money for them. The world of 1977, the death of equities, nobody wanted to buy stocks. Okay, that's why we had to come up with this idea of what was a business worth and who would buy it, and we call it the private market value of a business. And so that was a marketing pitch to get people to think about even owning stocks. And that was only 30 odd years ago.
Right.
360 months ago.
I love how you calculate things, you're so data driven.
Well, I can also tell you how much it costs to buy a bottle of beer then and now and today. But
so how much?
Today you can go to a...
No, how much then?
You probably have 25 cents.
Wow. That's amazing to think about that. That was only 30-something years ago.
Yeah. Well, I don't think you could do it at Yankee Stadium, though, but that's a different issue.
One of the things I've always loved about you, Mario, is that you were just talking about data. Like, I see you walk around sometimes and you have your briefcase full of papers, and there's no company that you talk about that you haven't read their annual reports, other research reports perhaps, or you haven't talked to you've talked to their CEOs. I mean, you do a lot of research.
Well, yeah, but that's our job. In other words, when I went to graduate school, okay, I knew that I wanted to be in the investment business. I took a course with Roger Murray, security analysis, and that was what said, this is what you want to do. So that was fundamental analysis in the Graham Dodd tradition of Columbia Business School. Roger Murray was the professor at the time, and Bruce Greenwald is now there for 20 years, and he's the current professor of a methodology of doing fundamental bottoms-up research. The legal industry does not understand that. They think all you're doing is calling companies and trying to get inside information. We're trying to get insights and collect and connect the dots. So when I read, and I follow the movie industry, you read Variety, it comes out every week, you read the trades, you obviously call all the companies, but you also read all the annual reports. So when you ask me what's going on in the world today, Betty, you have the following. You have the first quarter earnings out of your way. Annual reports start coming out middle of February through the middle of June, and you have the second quarter earnings. So right now it is the crunch time in the world in which we're investing on top of all the meetings that we go around the world and try to see as many companies. The second part that's changed is Tiananmen Square in June of 1989 and Berlin Wall in November of 1989. We were always following companies. For example, my first visit to China was in 1981. We went with Walter Kissinger, Henry's brother, to a plant with the auto analyst of New York. We went to Tokyo, and I would go to Europe prior to that to see companies in the automotive industry, as an example, which is an area in which we had core and competency with compounded knowledge. But we didn't invest. After Berlin Wall came down, we said we're going to have to invest globally. So now the next part was traveling around the world.
Right, there's a whole new world that opened up.
Well, it wasn't a world that opened up, but given a bottoms-up, hands-on, bottom of, touching and feeling what we deal with, we basically had to go visit these companies. And so if there's a meeting for Pernod in Paris and there's a meeting for Suntory in Shanghai, in Tokyo, you can't do it.
You're there.
No, we can't do it. You just can't do it. So you have a team that has been trained. Like we have an ABK, an American-born Korean, working for us in Shanghai for the last 10 years, and he covered the beverage industry. We have a guy in London, so if there's a meeting, he would go to it. So we have 3 or 4 analysts in various parts of the world. We open it, and that's what we do, and that's how you leverage that up. You can't get on planes and do that.
But I want to get back to you though. Okay, so I take it for a given you've got a great team around you who are doing lots of research as well and gathering information. But what about you? Like, how did you learn to coalesce and condense that information so well to allow you to invest in companies and make a lot of money?
Well, you became an industry specialist. So when I started my career, I was assigned Michael Steinhardt's industries. The sell-side institutional research had verticals. So you would be assigned the automotive industry. So you covered General Motors, Ford, Chrysler, whatever was public American Motors at that time. You'd cover all the truck companies, you'd cover all the original equipment parts companies, all the distributors. So I looked at this mosaic of companies, and I would go visit companies in Detroit, Cleveland, Toledo, Flint, Michigan, and so on. And then I'd go to Atlanta, Georgia to visit companies. I'd go to Houston, Texas. I'd go to California. So you'd visit all companies that were public in the United States as well as private companies. You'd read all the trades and magazines. And you would basically do spreadsheets. Those spreadsheets were done manually. So doing that, Betty, for 40 years, you have an accumulated and compounded knowledge of certain industries. And then you morph from that. For example, O'Reilly's, Advanced Auto were not public companies then. Pep Boys might have been.
Right.
Okay, and some of them like Genuine Parts, which is the NAP Napa stores, were public. And so you're following the same companies, and they go through cycles, and they go through business dynamics, and you learn how CEOs of these companies can handle new challenges and how they allocate capital. So we then picked up industries that were producer durables, like John Deere Farm Equipment. We picked up companies that were in the broadcasting industry, therefore they followed cable. They then followed, most of them got into the wireless business, so that got us into that part of the world. And you followed companies that were growth, you followed companies that were cyclical, you followed companies that were commodity driven. So you accumulate that knowledge.
It's institutional knowledge.
Yeah, you do. And what then happens is that you can read an annual report and cherry pick what you're looking for. So if I picked up an industry, if I wanted to follow something as exotic I said, as radiators for cars, I would read a year's supply of monthly or weekly trade magazines.
On radiators?
On radiators. I would
Are you serious?
Yes. I would get everything involved in radiators. So today, if you're a rookie analyst coming to me and saying, I want to learn about XYZ industry, okay, let's say I want to learn about what Tesla's doing with lithium batteries and electric vehicles, you would get him to learn everything about the power engines and the powertrains and the assemblies and do that, and how many man hours of labor are associated and so on. And that's not complicated. You just got to work at it.
Do you need to meet the CEO before you invest in him or her?
Again, when we follow an industry, we follow verticals. If you're dealing with a small company, we prefer doing that. Small company defined as market capitalizations of under $1 billion. If you're meeting with a company with a $100 billion market cap, there's not much value added you can do. Okay, so to the degree that I followed the entertainment business and to the degree that I've been doing it for a long period of time, obviously I've met the Igers of the world that are at Disney a long time ago, and Brian Roberts, I knew his father, and Steve Burke, and Jeff Katzenberg at DreamWorks, and Sumner Redstone, and Philippe Doman, and Les, at CBS, and so on. So you know the individuals, and then you try to stay current with them.
What do you look for in a good manager?
It's an interesting question. I look for a good business that will do well in inflation, deflation, and through stressful periods that are cash generators, which means that if I'm doing $1 billion of EBITDA, earnings before interest, tax, depreciation, amortization, I got to put $1 billion in back to CapEx just to maintain $1 billion. You have to question whether that's a good business. We had a company today called Energize. They make a battery. They do $300 million of EBITDA and they have CapEx of $30 million. That is a very good business. The question is,
so you look at business first.
Yeah, but you also look at the CEO. How is he allocating capital? Like Warren Buffett has a railroad business. He makes boots. He sells Dairy Queen, and I have to go out and have the Blizzard ice cream just to see what it's like. And so is he are these good businesses? And which ones are good? Okay, they just bought a company called Precision Cast Parts. They paid $34 billion for it. We are honoring the CEO of that company, Mark Dunnigan, at our annual meeting. We honor 4 CEOs a year, okay? And he's coming in because he's allocated capital well. Is Warren Buffett, how's he gonna do that with this conglomerate in the financial services? Because he's very good at allocating capital. So I make the distinction between a good business, which is important, where there's a moat around it, or an individual that knows how to allocate capital like Warren Buffett. And he's done a very good job at that. He's done extremely well. When we started our first mutual fund, Gabelli Equity Trust and Asset Fund, both of which are 30 years old, more or less, we bought Berkshire at $3,000. Mm-hmm. Today it's $220,000.
It's amazing.
Well, it's 70 times your money, but it's also big dollars. You could have made the same thing, however, by buying Netflix at a certain time, or Apple.
Or what about an Uber?
Well, it's private. We don't do private companies. We only buy public market stocks.
How would you describe yourself as a manager?
Terrible.
Why?
Because I expect individuals that we hire to be PhDs. Okay? Privileged? No. Poor, hungry, and driven. And so, some of them will come to us and, they're privileged, hungry, and driven, or will work hard, and some will come with us because Pop has dough. But
who do you prefer? Which do you prefer?
Well, it's hard to say. All of them will work. Some of them will not. It depends. I mean, we've hired people from southern states that have never been through snowstorms in New York, and we didn't think about that initially. And what do we need this for? Give me LA, and so the challenges of hiring, and then you want somebody that has a passion for stocks and not necessarily just a job, okay? So that's the challenge. About, let's call it 15 years ago, I got a call from Rick Pitino. He's coaching University of Kentucky. He says, Mary, I want to stop by your office. I got to figure out how he knew me. He stops by the office 2 months later, and he says, how do you hire these people? So I pointed out the analysts have that poor, hungry, and driven. That is, we go into business schools, we find the ones that have a passion for the market. So he wrote a chapter in his book when he was trying to find a money manager for Jamal Mashburn called The PhD Attitude. And so that's why I would like to have individuals that are motivated rather than me motivating them. We have a simple culture: make money for the client, and then make money for the teammates, and then make money for the shareholders. And that's the culture, and sometimes people lose sight of that, and that's a challenge. We don't like to motivate people. We like them self-motivated because that's the nature of the business, and we like them to understand the Goldman Sachs approach and Wall Street's approach back in the 60s, 70s of the ethics of Wall Street.
Which was what exactly?
Most of these firms were partnerships, so
Okay.
you knew what everybody was doing. And you watched everything because one partner making a mistake can impact the entire organization. The weakest link in a chain's weakest link can destroy the chain. And so they learned that when they went public, things started changing at the margin.
Do you like PhDs, poor, hungry, and driven, because you yourself have that in you?
There's no question. I learned to do research. When you're doing research, it's you have a team of two, you and someone else at most. So you have to know everything about a company and everything about an industry. Not only that, you have to know how the stocks react. So it's not only gathering the data, rating the data, projecting, interpreting, but also communicating it. But in addition to that, Betty, you have to understand how the stocks have discounted or anticipate what you're going to think about. So each one has different skill sets.
So, Mario, how do you fire someone?
It is an extraordinarily difficult thing when someone doesn't come to work and we hired that individual. We try to figure out how we can improve that individual. And there are times, as occurred in the cyclical nature of our business, where we have to re-examine how we staff up and how we move people around to different departments. So it is one of our biggest challenges here. We have an HR team and so on.
You're in so many meetings all the time, so how do you make meetings go faster?
Well, when we have internal meetings as opposed to external meetings, we like to think in paragraphs before we come to the meeting and then deliver sound bites so that the decisions are laid out in a very organized way, and then allow individuals to collaborate and think about their positions beforehand. So if you're an analyst and you come to a meeting and you're going to comment on the company's quarterly earnings, you probably should have read everything and understand the questions that people would ask you, just the way you would want to manage a client's money. It's just like if you were a doctor going in to operate on someone's heart, or a person that was setting up a satellite, and you had to know everything about it, particularly when somebody, or a spaceship where somebody was on it.
I like that, though. I like how you say you have to think of paragraphs and go in there and deliver them. What's a wise way to invest your money?
Well, we'd like to tell an individual who's 22 years old the following. Have one less Starbucks Americano a day. Put that $5 you save into an account by tapping it in on your iPad into a pay system, and even if it's robotic investing, have one less bear a week. And we're told that if you can compound at 6, 8, or 10%, just lay out the matrix for the next 40 years and how much money you'll have. You'll never miss the beer, you'll never miss the Starbucks, but boy, at the end of 40 years, you're gonna have a lot of money. So it's really just the notion of understanding the compounded rate of return on small sums of money accumulating over an extended period of time, and how that gives you economic flexibility. It's just a wonderful dynamic. The seventh wonder of the world.
What book changed your life?
I don't read a lot. I read a lot of annual reports. I read a lot of trade magazines. I read, there's 2 or 3 that deal with the auto industry, 3 or 4 that deals with the music and entertainment business. There's 2 or 3 that deal with some other industries, including those in the investment business. I actually read some strange things like the World Economic Journal's Asian report that goes back to when I went to Japan about 40 years ago and 30 years ago and started reading that. So but religiously read the journal and the business section of the Times, so that I understand how the world thinks about what I'm thinking about, and so that I don't miss anything from a different perspective. But even Ad Age, I've been reading Ad Age now for 50 years. And that's just a great insight in marketing trends and how consumers' behavior is going on, and understanding what I call the next generation, not the millennials, but the ones after that, which I call the digital world, the digital generation.
When is it okay to yell at someone, Mario?
All the time. As long as they know it's not at them. It's not an argument ad hominem, but it's an argument sui generis, and that is, it is basically coming out of a trading room culture, and if they don't understand that, then they really should not be in the investment business, to understand that there's a great deal of intensity, a great deal of pressure, and that's what makes the business that we're part of You have to understand if tomorrow North Korea launches a missile against China, as opposed to Japan or the United States, what the reaction would be and how stocks would react. No different than the day of 9/11 when I was in Nashville, how the markets would react. You have to be prepared for that. And that's, it requires a certain intensity, and to the degree that someone doesn't understand that, you should let them know.
What is your go-to interview question?
I'd like to ask them what they did in school. I need to know whether they were working during holidays. I'd like to know whether they just took trips. I'd like to know whether they just didn't do anything. And then in addition to that, how do they pay for their education? And then in addition to that, what's important to them? And obviously, I'd like to see how much research they did. If they just showed up because they were checking a box, we could figure that out very quickly. And you have a profile of individual. I can tell you what somebody from Vanderbilt or someone from SMU or someone from the University of Utah would be like. And we had one individual one time who was from Merrill Lynch. They hired him, and he said he went to Yale undergrad and Yale Business School. And I said, there's no way that guy went there. And he didn't go to either one. So, you know, you kind of get a sense of that. And you like individuals that want to come to work.
Well, you actually are going into my
But our business is different, okay? We really want someone that has a passion for the markets.
Right. Well, that goes to my other question, because you've interviewed and you've talked to so many people in your career. Like, how do you spot a liar?
Oh, you can't. You just get a gut feel for it. You know, it's just, and even then, it's a difficult thing. I'm not very good at that.
How do you motivate someone who has become lazy or has decided to not work as hard as before?
Well, that's a question mark, and I actually, particularly if I helped recruit that individual, what mistake did I make? So I'll go back to the individual and we'll try to say to that individual, hey, what's changing your life? What's really bugging you? And to the degree I don't get a good answer, that's not good. To the degree I get a good answer, then we try to figure out how to improve that, how to help that individual.
Mario, you're on the road all the time. How do you stay sane on the road?
You don't. You become the midnight prowler. I mean, how do you stay sane? You know, you have there's a difference today. It's an interesting world we live in. And that is, you can have devices like an iPad that keep me into the market. I get up at 4 in the morning, or if you go to LA, 4 in the morning is easy, because you're up at 4 in the morning in New York. It's and so you just stay in touch with the world, and you ignore a lot of other things. The problem is you eat too much, too often. You can have 5 different meals going out to LA in one day.
Well, that's actually the other question, is how do you stay healthy? I mean, you've been in this business for so long.
I have no idea. Drinking 3 glasses of wine, a Barolo per day, or a Poliac.
Is it your Italian heritage?
I doubt it. I just think it's pure luck.
If you weren't doing this, Mario, what would you want to be doing?
I really am not working, and I haven't worked since I started. I actually have a passion for the markets, and it is basically me against the world, which is a very interesting competitive dynamic. So I need to figure out how to gather information, array it, project it, interpret it, and try to be right more than I'm wrong. And my analogy is Ted Williams, who, you know, bat 400, he was the best hitter in time, but he made out 3 out of 5 times. So we know we're going to make mistakes. So you have to be practical about life. Okay. And so from that point of view, that's all we do.
So you can't see yourself, like, you've never been like, oh my goodness, if I could redo this again, I'd want to be like a baseball player, or I'd want to be, you know, you don't have any, like, you don't have a.
I'm basically very practical. I played stickball. I was very good at stickball in the Bronx. You don't know what that is. And basically, I played basketball, but white guys can't jump. And, you know, I'm not going to be an all-star basketball player. I still play basketball sometimes. And the practical reality is that I like the capital markets, I like competition, I like pressure, and I like intensity. And I would pay to work for someone if I could do all of those things on a global basis. So that's the beauty of what I do and what I've been doing and what I continue to do. And I do it because I have a moral and obligation to do my best and our team's best for the clients that entrust their money to us. And that's what we're going to continue to do for a long period of time.
Next week on Radiate, it's near summer. I'm so excited, which means people are out teeing it up on the golf course. But not me, because I can't golf. But instead, we have golfing great Greg Norman in the studio. He's going to tell us how he went from star golfer to one of the richest retired athletes in the world. What did he do right? And yes, we discussed the moment that nobody will let him forget, that huge loss at the Masters that people still talk about to this day. How did it define his career? Well, thanks for joining us. I'm Betty Lou. If you liked what you heard, please review us on iTunes. Give us 5 stars, please. And if you'd like to subscribe to my newsletter, go to radiateinc.com. And as always, find me on Twitter, Facebook, and LinkedIn. See you next week on Radiate.